The silver market in its current phase places observers in a very different position compared with more typical periods of volatility in the past. Silver is now trading around USD 78.34, following a sequence of sharp consecutive declines that have broken multiple technical levels and completely reversed short-term market sentiment. It is important to clarify from the outset that what has just occurred is not merely a price correction, but a state transition in the overall structure of the silver market. Within a short period, silver has moved through the full spectrum of market phases, from strong gains and exuberance to consolidation and then to a rapid sell-off, while volatility expanded far beyond historical averages. Unlike previous declines, which often unfolded amid weakening liquidity or a lack of guiding information, this downturn occurred precisely when positioning and expectations were most crowded. The core distinction of this episode lies in the fact that selling pressure did not primarily stem from a deterioration in long-term conviction, but from structural pressure within the system, where positions accumulated during the prior rally were forced to reprice and reposition as market conditions shifted. The latest signals affecting silver did not originate from a single catalyst, but from the convergence of three major flows: profit-taking and leverage unwinding after a prolonged advance, a shift in global risk appetite across financial markets, and, most notably, behavioral adjustments by large funds as short-term supply-demand dynamics became imbalanced. Capital during this phase did not exit the silver market indiscriminately. Instead, it moved selectively, creating localized liquidity vacuums that made price moves steeper and faster than usual. As a result, heightened volatility does not reflect uniform panic, but rather the collision of capital layers with very different reaction speeds. Investor behavior has shifted accordingly. Participants who entered primarily for short-term momentum have begun to withdraw, while longer horizon players have moved into a wait-and-observe mode, seeking confirmation before acting. All of these elements reinforce the conclusion that this is not an emotional story, but a structural one, in which the market is compelled to recalibrate after an overheated phase. What matters is not how much silver has risen or fallen, but the direction in which the market structure itself is evolving. At this point, anchoring perception to price reality and structural context is critical to avoid unfounded speculation. Silver, around USD 78.34, is now trading well below the most recent peak formed during the prior rally, while approaching price zones that historically functioned as accumulation areas. Relative to the most recent low of the current decline, this level suggests the market is still searching for a new equilibrium and has not yet established a stable base. In historical terms, silver remains in a high volatility regime, with daily and weekly ranges far exceeding long-term averages. The pace of the recent decline has been significantly steeper than the speed of the preceding advance, highlighting the dominant role of yuan forced selling from leveraged positions. Expanded intraday ranges indicate that consensus has not yet formed, as each new data point is capable of triggering sharp reactions in either direction. One notable feature is that, over the same period, silver has declined more rapidly than gold, underscoring a clear divergence within precious metals, where safe haven flows are favoring assets perceived as more stable in the short term. Market reactions to news have also become asymmetric. Positive developments no longer generate durable upside, while negative news amplifies volatility, evidence that defensive psychology is currently in control. This description is not intended as a forecast, but as a clarification of the market's current position within the broader cycle. When examining capital flows and behavior, the picture becomes more defined. Capital has not abandoned silver outright. Rather, it has exited the highest risk structures, particularly highly leveraged products and short-term positions built on expectations of rapid appreciation. In contrast, longer-term capital and flows capable of absorbing physical supply have begun to emerge during periods of peak stress, highlighting the divergence in approaches among participant groups. Physical silver holders tend to react less to short-term volatility, as their decisions are typically tied to long-term value preservation. Silver ETF holders respond more dynamically, as the instrument allows rapid position adjustment in line with inflows and outflows. Leveraged participants face the greatest pressure, as steep and rapid price moves force position reductions to meet margin requirements. Silver mining equities experience a dual impact from silver prices themselves and from broader equity market sentiment, often resulting in volatility that exceeds that of the underlying metal. From a psychological standpoint, the market is currently exhibiting three states simultaneously: panic among undercapitalized and highly leveraged participants, suppressed greed among those who missed the previous rally and are waiting for opportunity, and hesitation among current holders who have yet to identify the next dominant structure. This coexistence is typical of critical transition phases within a cycle when the market is reallocating roles among participant groups. In this environment, the latest influencing factors must be assessed systematically and flexibly. At the macro level, interest rates and rate expectations remain foundational, as they define the opportunity cost of holding non-yielding assets such as silver. Any shift in monetary policy signals or central bank communication can exert a strong influence on capital flows. The US dollar and inflation expectations also play key roles, affecting both safe haven demand and industrial consumption. At the financial market level, equity volatility, margin dynamics, and episodes of forced selling have amplified short-term silver price swings. When liquidity is drawn toward other assets or systemic risk rises, silver can temporarily become a source of liquidity. At the silver-specific level, industrial supply-demand dynamics, inventories, and the actions of large funds remain critical variables. Any divergence between paper silver and physical silver prices, if it emerges, warrants close monitoring as an indicator of stress within the distribution structure. From these elements, three primary forward scenarios can be outlined without committing to a single directional forecast. The first is recovery and trend continuation, contingent on renewed stability in broader financial markets, full relief of leverage pressure, and sustained long-term capital participation. Confirmation would come from contracting volatility ranges and more constructive reactions to supportive information. The second scenario is sideways consolidation, in which the market requires time to absorb information and rebuild confidence. This phase often frustrates participants expecting strong directional moves, yet it plays a vital role in structural reinforcement. The third scenario is a deeper decline, should macro conditions deteriorate rapidly or a new liquidity shock materialize. In that case, the most severe losses are typically borne by highly leveraged participants who lack risk contingencies. Even so, such a move should be viewed as structural cleansing rather than the end of the silver narrative. When segmenting silver holders, the appropriate mindset becomes especially important. For physical silver holders, the focus should be on supply-demand structure and access to metal. Impulsive reactions to short-term price movements should be avoided. For silver ETF holders, understanding structural risks, liquidity advantages, and the influence of fund flows on behavior is essential. For leveraged participants, the market has delivered a clear reminder of the dangers of rapid volatility and the critical importance of capital management. For silver mining equity holders, it is crucial to distinguish between metal prices and equity prices, as the two are not always aligned. Finally, several common misconceptions must be addressed to avoid unnecessary panic. The belief that a silver decline means the story is over. The equation of ETFs with physical silver. The underestimation of leverage risk simply because the market has not yet collapsed, or the assumption that silver equities always track silver prices. Each of these misunderstandings can lead to flawed decisions if not evaluated through a structural lens. In closing, the silver market is delivering a clear message. This phase demands deep understanding of instruments and one's position within the cycle, rather than emotionally driven reactions. The most important principle to remember is to understand what you hold, why you hold it, and how much risk you can truly tolerate. Markets do not destroy participants because they are wrong, but because they do not fully understand the tools they are using. Building on the analysis already developed, it is necessary to take one further step to clarify the deeper significance of the USD 78.34 price level within the current structure of the silver market. If the discussion stops at describing volatility and outlining scenarios, observers risk falling back into the familiar loop of waiting for a right direction signal rather than understanding the nature of the phase itself. The USD 78.34 level is not merely a price that sits below the previous peak. It represents a point at which control within the market begins to shift, from momentum-driven participants toward capital that can tolerate and absorb risk. When silver was trading at elevated levels, the dominant narrative revolved around who would buy next. As prices fall toward the current zone, the critical questions change to who is being forced to sell and who is capable of not selling. This distinction is fundamental because it marks the transition from an expectation expansion phase to a phase in which the resilience of the market structure itself is being tested. At USD 78.34, silver is compelling the market to expose weaknesses that were masked during the rally, most notably excessive reliance on leverage and short-term capital. In price zones like this, markets no longer respond primarily to surface-level news, but to internal systemic pressure, where even minor fluctuations can trigger cascading actions. This explains why the same piece of information that would have been ignored at higher price levels can provoke outsized reactions at current levels. It is not that the information has become more important. Rather, the market structure has become more fragile. In this context, observing the behavior of large funds and entities with absorption capacity can help decode market conditions, but such observation must not be confused with mechanical imitation. Vehicles such as iShares Silver Trust, SLV, operate under distinct structural constraints. Their buying and selling decisions reflect portfolio balancing requirements, capital inflows and outflows, and obligations to maintain product integrity, not discretionary views on short-term price direction. When their actions are viewed through the lens of the USD 78.34 level, it becomes reasonable to infer that the market may be entering a phase where absorption and liquidation coexist, creating a prolonged state of tension. Such phases are typically uncomfortable for participants. They lack clear relief rallies, yet they also do not collapse outright, forcing both bullish and bearish participants to exercise patience. This is precisely where the difference between understanding structure and chasing price movement becomes most apparent. Those focused solely on price may perceive the market as slowly dying, while those focused on flows and behavior recognize a market in the process of reallocating roles. On a broader level, this phase also forces observers to reconsider how risk is defined. In the silver market, risk is not limited to how much further prices may fall. It lies equally in the misuse of instruments during periods of structural instability. A tool that is relatively safe during consolidation can become extremely dangerous during steep volatility, and vice versa. For this reason, understanding the relationship between instrument choice, timing, and market structure is far more important than attempting to predict precise tops or bottoms. Looking back over the path from higher price levels down to USD 78.34, it becomes evident that the silver market is undergoing a form of forced deceleration, one driven not by a gradual shift in sentiment, but by the hard constraints of capital and liquidity. Such processes tend to leave lasting imprints on market structure, as they force participants to internalize the scale of risk that has been experienced. Consequently, even if future rebounds occur, market behavior is likely to be more cautious and less willing to re-embrace risk than in the prior phase. This is neither inherently positive nor negative. It simply reflects structural maturation after a shock. For observers, the core message of the current phase is a shift in focus, from asking, "Where will price go?" to asking, what is the market demanding from participants right now? If the market is demanding discipline, a lack of discipline will be punished swiftly. If the market is demanding patience, impulsive action becomes the greatest risk. In closing, USD 78.34 should not be viewed as a conclusion, but as a temporary waypoint in the ongoing restructuring of the silver market. What unfolds next will depend on how large and small capital flows interact within the broader macro and financial environment. For those who follow silver seriously, the priority at this stage is not the pursuit of certainty, but the development of a mindset flexible enough to avoid being pulled into every short-term fluctuation. Markets do not require participants to be right at all times, but they do require them to understand what they are doing. In periods of heightened volatility such as this, that requirement becomes more demanding than ever. Finally, several common misconceptions must be addressed to avoid unnecessary panic. The belief that a silver decline means the story is over. The equation of ETFs with physical silver. The underestimation of leverage risk simply because the market has not yet collapsed, or the assumption that silver equities always track silver prices. Each of these misunderstandings can lead to flawed decisions if not evaluated through a structural lens. In closing, the silver market is delivering a clear message. This phase demands deep understanding of instruments and one's position within the cycle, rather than emotionally driven reactions. The most important principle to remember is to understand what you hold, why you hold it, and how much risk you can truly tolerate. Markets do not destroy participants because they are wrong, but because they do not fully understand the tools they are using.